Hey, everybody. Thank y'all so much for joining us again for another AIME Live. I am here with somebody who you may not know, but you absolutely should. Chris Mayer. He is the CEO over at Longbridge Financial. They're a brand new partner to AIME this year. Chris has a very interesting background, though, that I want to dig into before we get started. He is a professor. He is an economist. He teaches at Columbia Business School right now. Chris, can you give us a little bit of how did you get into mortgage?
I actually got into mortgage when I was a third-year grad student at MIT.
Okay.
And, I was living off of my wife's earnings. She had a great living as a working in pharmaceuticals. And we decided for some odd reason we were going to buy a home. And so I was a third-year grad student. I was kind of struggling to figure out like what was this whole thing about buying a home? And I didn't really have a good thesis topic. So I spent the year working on our home. At one point, this was back in the day when you looked in the business section to find mortgage rates. And so in the back of the Boston Globe, I actually looked and found 50 lenders who listed their mortgage rates in the newspaper. For those of you who have some age, I called all 50 of them. So I've been kind of obsessed about trying to understand mortgage rates ever since. I did my dissertation at MIT back in the day on selling real estate, distressed real estate auctions, and subsequently got a job at the Fed and have continued to study housing and credit markets for much of my career. So very, very different background than most people, but something that I've always been fascinated with from the moment of buying a home and realizing how big a deal it was.
So what is it about mortgage that really caught your attention I know you've said the industry overall is something that you just got really interested in really fast, but was there one specific thing that really pulled you in and kept you interested over all this time?
I guess to me, it's still the idea that you're buying a home. It's a huge purchase. It's incredibly large relative to the rest of your life from a financial perspective. And, what you're doing with the mortgage is making a commitment, a very long-term commitment to make payments and understanding what that means for borrowers, understanding what it means for the financial system, which we basically saw in, the late 2000s collapse. And we've seen across, other countries and other times, the mortgage market is big enough to take out our financial system, to take out savings and loans, and to require, really significant bailouts from the federal government. And on the other hand, it's that large because for each of us, the obligation is really important. So for me, as an economist, I see it, both for the economy and the stability of our financial system. And, from a homeowner's perspective, recognizing the commitment that it is, and then over time, recognizing what this means for you as a first-time home buyer, the obligations you take on from somebody in retirement, trying to think about how are they going to live and are they going to be able to make mortgage payments. So for me, it's both about people and about kind of the financial system and the economy.
So let's take a look at the people side of that for a second, because we've had some conversations before. Barry, Habib, and I have talked about it a handful of times that, different generations have handled mortgages differently, or housing and how they look at housing and when they want to buy and when they don't. But you said something before we got started that I thought was really interesting. If you really look back over time, most generations are actually investing in home buying around the same period of their life. Can you expand on that a little bit?
Sure. And actually, it's been trending older for a long time. So if you go back and look, the first thing is that the vast majority of Americans, 85 to 90% of Americans, at some point in their life will buy a home. And that's true, more than 2/3 of people who never graduated from college will be homeowners. So when you think about homeownership is one of the few things in this country that unites everybody. And, when you look at people who are 65 years old, 5 in 6 of them own a home. So the data suggests people eventually become homeowners. One of the reasons that the homeownership rate has been kind of shrinking over, time, over decades, even going back to the 1990s, is that people have been buying a little bit later. And part of it is that people are getting married later. they're, dating. They're sometimes not getting married at all relative to what they used to, relatively what they used to do. And so people are kind of settled a little bit later in their lives. It's not going and working for the same company for 30 years and getting, a union paying job for kind of people who are kind of in the, in the bottom half or the, of the income distribution. For people in college, more going to graduate school. So all of these things have kind of pushed the home buying decision a little bit later. And you've seen kind of the average age of a first-time home buyer kind of rising, or the home ownership rate of people in their 20s and 30s has been falling for a long time, other than sort of a brief blip up in the mid 2000s when, owning one home was great, owning two homes was even better. That obviously didn't end that well. But, that's been a pattern for a long time. To me, the big thing, and, I've written with Lori Goodman at the Urban Institute about home ownership. Home ownership is a path to financial stability for Americans. And people who are not homeowners have a really tough time in retirement. Even people who have homeowners who have a mortgage have a real challenge meeting their mortgage payments. But the idea of owning a home, earning that equity, it's a proven path to hitting retirement with some, with a reasonable likelihood of being successful.
We have a member of ours, excuse me, his name is Chris Griffith. When I first started working with AIME, he was one of the very first people, and now we have plenty of members that preach this all day, every day. So not taking anything away from those guys, but Chris was the first one to sit me down and say, a house isn't just where you live, it's an asset that you need to be leveraging for financial security long term. And that's something that I would, as a millennial, we've talked about various generations, and we'll get into the weeds on those in a moment, but that's not something that was really taught to me, right? I was always taught growing up, you buy a house because that's where you live with your spouse and with your family, and that's where you raise them, and that's what you do, and that's what everyone in my family has always done. But we're really at a position, especially now with a lack of inventory, raising home prices in lots of major markets across the country, that it's an investment for long-term financial wealth and to build stability over time, not just to, lay your head for the time being. Can you expand on that a little bit for us, for maybe some of those that aren't as familiar with that concept?
Sure. I mean, I think when you buy a home, you save in two ways. One of them is the home you buy on average goes up. And I think we don't want to look at the last year or two, but you can look at 40, 50, 60, 100 years of data and find that home prices in general go up about with inflation, maybe a little bit above inflation. And if you're on the coast, it goes up, it can easily go up 2% or more above inflation. So you buy an asset and it increases in value. At the same time, every time you make a mortgage payment, you're lowering the amount of money you owe. And so a fully amortizing loan has this benefit that the amount you owe goes down and your home equity goes up. And the combination of those things is a powerful saving tool. If you look at people 55 to 64, only about half of them have an IRA. So when you kind of ask people who are struggling to pay their bills, meet all their obligations, saving can be tough. But when you buy a home, you have this auto saving device, which is basically, you earn equity and the mortgage amount goes down. The problem with that tool for many people is that as they get older, they start to tap the home and continue to pull money out.
Yeah.
And one of the problems is that over time you start to owe more money. And so that has a diminishing effect on home equity. And so in terms of savings for Americans, the appreciation is the big place that many people make their money over time. And, when you look at people, you have to go up to about the 90th percentile of the wealth distribution before people have more other assets relative to home equity. So as you said, for most people, the vast majority of people, that investment in the home is the biggest asset. And if you look at people who are in their 50s and 60s living in the Bay Area or, Orange County or, the suburbs of Boston, they've had incredible success at watching that home go up in value. But even if you go to, look in places in, in Texas, in Florida, where home price appreciation overall hasn't been as big, again, the home has been a tremendous investment for those people.
Absolutely. I mean, I can speak to my personal experience. I'm from Dallas. That's where my house is. I'm up in Philly with the AIME team all the time, but my townhouse that I still own and, technically live in, although I'm not there as much as I would like to be, from when I bought it in 2016 to where it is now. I mean, it's crazy. And I'm lucky that I'm in a really nice area of the city of Dallas proper, right? I'm not in a suburb, and it's continued to appreciate pretty aggressively over time. But it's true. If you really look at it as, I love what you said, an auto savings tool, right? Especially for young and first time home buyers, right? To be able to leverage a tool like that it's not sitting in your bank account. You can't go a little bit crazy on the weekend or go buy something spur of the moment because you feel like it. It's all being put into an asset that you're going to be able to leverage later on. It's a great way to save, and to save if you're building your financial wealth early in your life.
Yeah. And I will highlight that your point is exactly right. And one of the problems that we have, and many retirees have, is that they forgot about the part about continuing to save, and they started thinking about the part about, oh, wait, that is just like a piggy bank. So I can pull all my money out and then do stuff with it. And so there's a generation of people who in the mid 2000s did a lot of cash out. And, in the previous refi wave, which was back in, 2003, 2004, when rates really declined and we saw refinancing rates kind of where we're seeing them today, a lot of people did cash outs. A majority of those people were taking cash out of their home, less so today, but that left a lot of those folks back with higher amounts of debt. And that's one of the sort of challenges, is how do you think about where you're sitting at different points in your life cycle? But if what you do is pay down that loan and, have it amortized, it's a great, vehicle, and, refinance where you can, get savings and take advantage of that opportunity.
Yeah. And for that generation that's a little bit older, right? When we're looking at, boomers that are sitting in that 60 plus range, I think, one of the stats that we were able to look at earlier in early conversations with you and the team over at Longbridge, this is the highest amount of equity on record of any generation ever. Is that correct?
It is. More than $8 trillion
wow.
of home equity is sitting with people who are 62 and older. And
so how can they leverage that in a way that still ensures, people are also living longer, right? I think one of the things that we forget to talk about is that, yeah, it's great. You've got this asset that you can leverage in your early 60s where, before maybe that's 10 years worth of lifetime. And now it's 15, 20, 25, depending on who you are and where you live. So how do you leverage that without depleting your security and then finding yourself in the same position 10 years from now?
Well, I think, as you know, I've gotten into the reverse mortgage business with our company. I will say that my history of reverse mortgages goes back to that time just after I left graduate school, when I was, studying, working at the Fed, studying retirement. And I wrote a paper on reverse mortgages back in 1994, which was really looking at the value of home equity, exactly the question you raised, the value of home equity, or the potential value in terms of retirement. So when you look at people in retirement, Social Security, if you retire at age 65, replaces about a third of your income. That's a tough replacement rate, particularly because at age 65, about half of all homeowners today have a mortgage payment to make. Wow. So imagine you're thinking about retiring, and on one hand, you're replacing 30% of your income. Half of those people don't have an IRA or a 401k, and then they have to make mortgage payments on top of it. So that basically is an impossible retirement plan. And what's been happening is people have been pushing off retirement. The problem is they can't push off retirement as much as they'd like, because you have health issues and other things. So the question is, how do you kind of have a product that on one hand doesn't have required payments that are very difficult for people to make on a fixed income, and at the same time giving them flexibility if they want to make payments, if they want to make interest payments on their product? That product is called a reverse mortgage or a HECM. It exists. It's not some crazy thing that, would be kind of looked at as too good to be true. that product is available for people who want the flexibility to be able to make or not make payments as they want, take advantage of tax deductions, pay interest if they'd like. But for many people, it gives them the ability to have control over their finances, because a lot of the things about using home equity start with the fact that before I even get to be able to use home equity, I have to be able to stop making mortgage payments, which are very difficult for people on a fixed income, particularly people who don't have defined benefit or, traditional retirement accounts, which many fewer people today have. The big companies that, used to give all of us or our parents, these nice retirement accounts don't exist anymore.
Right.
So for them, the idea, first is, if I'm going to be looking at retirement, can I get rid of a mortgage payment, or at least get rid of a required mortgage payment? And then the second is the ability over time to be able to use a line of credit where you can use the home equity as you need it. And the critical thing is, you don't want people going and pulling all their equity out of their home at age 65. What you want them to do over time is basically say, I'll use it when I need it. And when I don't need it, I'm going to kind of leave it there. And maybe I use some of that equity to go back and pay property taxes and insurance. Maybe I use it. I'm going with my, now the COVID, people are getting vaccinated. We can travel. I'm traveling with my mom and stepfather, and they and all of the kids and grandkids are going to rent a house in San Diego, and kind of one of these bucket list trips that they get everybody together in one place. And for them, that's something that they can fund that is meaningful while they're alive. So the ability to use home equity to do some things that are the kinds of things you really want to do, but at this, also recognizing that not having to make, large mortgage payments for people into their 80s and 90s is a really big deal for retirees.
Absolutely. And we've got a couple of people, shouldn't say a couple, we have a handful within our community that are really invested in the reverse mortgage space, but there's a lot of people that are interested in just learning more about it. One of the caveats that we throw out there all the time is, if you're not an expert, don't try to tackle something that you don't know. Learn it, refer it to somebody who is an expert, and then, study it, get into it. And this is definitely one of those spaces where things can go awry really quickly if you're not sure how to navigate this product and you don't know the type of advice that you want to be giving. So what are some of the just a couple of key things that people can learn and take away to say, if I want to get into reverse, or I have a client that could potentially benefit from this type of product, what do I need to know to make sure that I'm positioning them the best way possible to make sure I'm getting them what they need and not putting them into a situation that's going to wind up damaging their long-term security?
Right. So the first thing about a reverse mortgage, you hit on, a bunch of things. I'll try and unpack it a little bit, and we can kind of go back and forth. The first thing, our company has a program called Reverse Made Easy. And this is one of the things we've talked to AIME, that we recognize that most brokers don't understand what a reverse mortgage. Most of them are sort of a HECM product, although we do have, proprietary products, jumbo for higher home values. But the HECM product is a product that is guaranteed by the FHA, U.S. government, as long as borrowers meet conditions, which importantly, the things that can get you in trouble with the reverse mortgage are basically the same things that can get you in trouble with a traditional mortgage. You don't make property tax and insurance payments. You're not living in the home. Those are the two biggest of those things. So you have certain obligations, but of course, the obligations are much lower than they are with a traditional mortgage, because you're not required to amortize a loan, which is to pay it down or pay any interest. So a reverse mortgage immediately starts with the idea that it is actually about safety and security. It is a product that is about trying to ensure that you can sustain home ownership for the long term. And when we talk about the product, we really think, and I think this is true of brokers, which is, think of your parents or grandparents. Or for a few of the folks themselves, and kind of ask the question, what is it that you would want when you were, looking for a mortgage product, which is you'd like a reasonable rate. You don't want to just sort of face the risk of losing your home. But for the vast majority of people, those risks are actually greater with a traditional mortgage. than they are with a reverse mortgage. And this is, again, there are a lot of misnomers that people have about the product, but you're not going to, if you have negative equity, you're not going to get kicked out of your home. You're not going to be required to make payments. And the line of credit that you get with a HACM is actually guaranteed to grow at the underlying rate of interest as long as you meet the obligations that I talked about for a mortgage. So a HACM really is about safety and security, and it's about ensuring that people are able to do the things in retirement that they'd like to do. So I put that out as the first thing. And I think for this, people really need to get educated. And we offer sort of short training sessions, and we're going to be doing some of these with AIME, in part just to help people understand what the product is, where it's appropriate, where it isn't for people.
Yep.
The process itself, I think, is actually something that we work pretty hard to make it easy for brokers, particularly people who haven't done them before. We kind of find that there are people, when they do their first reverse mortgage, need a lot of hand holding. For them, it's trying to really learn and understand, just as they're trying to educate their clients. And over time, once they figure it out, they realize that, there's a lot of people out there who are in this demographic. So in 2018, 2.3 million people 62 and older applied for a mortgage. 2.3 million. Of that 2.3 million, 1 million of them didn't actually take out the mortgage.
Wow.
And so the question is, why did that 1 million people not take out a mortgage? And if you think about the statistics I talked about earlier, low replacement rate of income and Social Security, people who would like to work longer but have a hard time doing so, you're immediately recognizing that they don't have income. And the problem for the people, the biggest reason that people 62 and older, that 1 million people didn't take out a mortgage, was because their debt to income ratio was too high, or their payment to income ratio was too high. They couldn't qualify for a traditional mortgage. So then the question is, what should you do with those folks? And the obvious answer is, instead of just telling them, I'm sorry, I got nothing for you, the honest answer is you should be looking at a reverse mortgage and kind of asking the question, is this a more responsible product for these people? Because they have a traditional mortgage today. They're making payments today. And, being in a position where they don't have to make payments they can't afford is a critical thing. So for those group of people, you're actually serving your clients better by, rather than telling them, I got nothing for you, you can earn a good commission, but at the same time serve your clients. 1.3 million people took out a traditional mortgage of some type. Almost half were HELOCs. So for many of the brokers, they're also out of their wheelhouse, because if you either have HELOCs or you don't, HELOCs are not, often a tough product for brokers to originate. Mm-hmm. But if you kind of ask, is a HELOC a really good product for somebody 62 and older? They're going to have 10 years of interest-only payments. And at the end of 10 years, their payment is going to become a fully amortizing loan, typically for 15 or 20 years. So you have a client who's 65. When they're 75, their payment is going to jump up and stay high. And the question is that really an appropriate product for that client? And so by thinking about a reverse mortgage, a HACM, what you're doing is bringing the client a product where they're never going to face a jump up in payments because they're not required. They can make interest only. We have a lot of clients who actually pay interest on their reverse mortgages because they don't want the balance to grow. They want to give something to their kids. But, maybe they get into December and say, I want to put the money towards helping, to buy a great gift, to buy gifts for people. Or they say, I want to help my grandkids with student loans. So maybe I'll put some of my money to helping my grandkids. So they have the flexibility to make payments or not. But for those borrowers, a reverse mortgage is often a better product. And, putting somebody who's 65 years old into a loan where they're going to, at this point, be making 25 or 30 years of payments. So for a 65-year-old, the average life expectancy is 18 years. So you're basically putting them in a product that they will be making payments for the rest of their lives. And kind of ask, is that really the most appropriate product for the client?
Yep.
And should the client at least have some opportunity to look at other products? And I think as they start to do that, they'll find they're actually serving their clients better as a broker by giving them some other options and put them side by side, show them what the opportunity is. And that's something we can help with through the Reverse Made Easy program.
Absolutely. We talk all the time, and that, the rallying cry and the motto of our entire community is that brokers are better. And the big focus the last 6 to 12 months has been why, right? We've said brokers are better. We talk about it all the time, but how are we proving it? How are we living it? How are we putting it out there? And knowledge of understanding non-traditional lending options is a huge component. We've done a ton of deep dives on VA loan misnomers and why you should work with borrowers that have more bruised credit, help them get into a different financial situation over a period of time. Reverse mortgages are another component that people have this concept in mind of what it is or what it stands for. That's really not the case, right? It's a very different product, and it's something that should be in the suite of things that you're offering to your community if you want to serve everyone in your community to the best of your ability, which of course is the message and the creed and the cry of everybody that's a part of our network and everybody that's a part of AIME. So
yeah. I mean, look, your point about brokers is just completely correct. And it's one of the things that we as a company have really been focusing on is why do you serve brokers? Because they're not following a script on the phone. They're actually sitting down with somebody and having a conversation. They're trying to understand what is best for their client. And by having those conversations, you're really well equipped, as you said, to sort of think about what are the options for the clients? How can I serve them best? And so that idea of how do I serve my client best, I think, for somebody, typically 15 to 20% of mortgage borrowers are 65 and older, and a little bit higher share, we have products that go down to age 60. So you're talking about a meaningful share of the clientele. And frankly, those are people, to our conversation earlier, who have a lot of home equity,
right,
who have a lot of assets. And the question is, how can you best serve them? And I think you find with reverse mortgages, the day I did a study with Professor Stephanie Moulton at Ohio State, and we looked at the 2018 HMDA data, and we looked at mortgage rates for people who took out a reverse mortgage, and we looked at people who took out traditional mortgages. The mortgage rates were very similar. This is not a product that is, that has crazy high rates that are really hard to serve your borrowers. This is a product that has reasonable rates that, there are higher closing costs associated with the loan because you're buying mortgage insurance. And the mortgage insurance says no matter what happens, you will never owe more than the home is worth. Your heirs aren't going to owe more. Your estate isn't going to owe more. No one's going to owe more than what the home is worth. And so that mortgage insurance has a lot of value because imagine, today, could home prices go down 5 or 10 years from now? Is it possible? If you look at, Google searches for the word housing bubble, or housing crash, they hit record levels in March. So a lot of people are worried. And one of the things that, you kind of realize is that negative equity, which was, handcuffed for many people, coming out of the Great Recession, for people who do reverse mortgages, what you're getting is insurance that says you're not going to owe more than your home is worth. As long as you, again, meet the, you pay your property taxes and insurance,
Yep.
live in the home, you do you maintain the home, you do the things that you normally do that are required of a traditional loan.
Absolutely. Chris, we are running up on time. It has been so great to have you and so helpful. And just, again, guys, it's all about expanding the number of products that you have information about, that you have access to, working with partners that can make those products available to you and help make it as easy as possible to work with. Chris is talking about a lot of great programs that Longbridge offers that help kind of hold your hand all the way through to make sure that your client is being taken care of the same way that you would take care of them. They want to work alongside you and make sure everybody that's getting into this type of a product is being served the best way possible. So, Chris, thank you so much. Any last words from you?
Sure. I think, Katie, look, I appreciate the conversation. And I really appreciate the broader context because I think as mortgage brokers, you really need to understand the environment you operate in. You need to understand your clients and how you can best serve what they're doing. And I think on, the reverse mortgage side, my one warning is they kind of get a little addictive. Which is to say people, once they kind of understand what they're doing, kind of do more of them. And, we don't find people who do one and then never come back again. They kind of do one, then they realize what it is, then they kind of learn a little bit more. And so they're kind of a bit addicting. And once you realize, the benefits of this, you start to be able to understand how to find clients. And particularly at a time when, refis, the simple, throw them down, they qualified once, you did the last loan for them, you can do this, I say you do this in your sleep, but you're serving your client and in every way it's great. We just know that's not going to be, we're not going to see as much of that going forward. And we're going to be back in the world of how do I build and grow my business? How do I serve a broader set of clients and really create the most I can out of my business? And this is a product that really has a lot of opportunity because we know every year 10,000 people retire. Every single day, 10,000 people hit retirement age. It's not every year. Every day, 10,000 people hit retirement age. And that number is going to grow, not shrink. And people are living longer. So the size of this demographic is a size that you really want to think about serving for your clients and to add more. So we think it's a great product. We really want to work with all of you to try and help you do this in a responsible way that is all about serving your clients. That's at the end of the day, that's what we're all here for.
Exactly. That's what we're all here for. Y'all, if you have any questions about reverse mortgages, different generations of home buyers, Chris can tackle them all. Where he's not just an expert on one generation of homeowners and home buyers. He is an expert across the board on generational impact of housing and home buying and what that can do. So drop those questions in the comments. Let us know. We'll work with the team over there to get you some responses. If you want to learn more about the reverse space, same thing, email us, partnerships@aimegroup.com. We can get you connected. Chris, thank you so much. It was great having you.
Thanks so much for having me, Kate. I really enjoyed the conversation.
All right, we'll see y'all later.
Bye-bye.